Okay, so how exactly do billionaires go out and buy sprawling estates, private jets, or, mega yachts without ever cashing out their investments? I mean, it sounds a little bit like magic, right? But it's actually a highly calculated, widely used financial strategy. If you've ever found yourself wondering how the ultra-wealthy seem to spend millions while their net worth just keeps going up and up, well, you are in the exact right place. Welcome to this explainer.
Let's jump right into this with Section 1, the Billionaire Yacht Paradox.
Picture this. Highly specific, but very real scenario. We've got two extremely wealthy individuals, and they both want to buy the exact same $100 million luxury yacht. Now, billionaire A, they go the traditional route. To get the cash, they just sell $100 million worth of their company shares. Simple enough, right? But instantly, they trigger this massive chain reaction. By selling, they actually shrink their wealth because suddenly they might owe millions in capital gains taxes, and even worse, they've permanently lost that chunk of ownership in their company. But then you have billionaire B. They take a completely different path. They acquire that exact same yacht, but without selling a single share of stock. There's no sale, which means there's no loss of ownership. Their original investments are kept entirely intact, just humming along and growing in the background. So, you gotta ask, how on earth is that even possible? How do you spend $100 million without actually liquidating $100 million? Let's look at why the ultra-wealthy are basically operating by a completely different set of rules when it comes to spending.
That brings us to Section 2, Understanding Wealth on Paper.
To really unpack this mystery, let's look at a hypothetical case study. Imagine a wildly successful tech founder. We'll call him David. David has built this incredible business, and his company shares are currently valued at an astonishing $1 billion. It's a massive number for sure, but the absolute crucial thing to remember here is that this is just wealth on paper. Having shares worth $1 billion is absolutely not the same thing as having $1 billion in cold hard cash sitting in a checking account ready to be spent. It's literally tied up in the business.
So, a situation pops up where David suddenly needs $20 million in cash. If he hits that sell button, he loses his ownership stake, and you better believe the taxman is going to come knocking for a hefty slice of capital gains. David intensely wants to avoid that. So instead of just liquidating from his brokerage account, he approaches a private bank for a completely different solution.
Here's the workaround, and it completely hinges on one concept: collateral. Instead of a sale, David pledges his valuable shares to the private bank to secure a $20 million loan. The agreement is pretty straightforward. If David fails to repay the loan, the bank is legally granted the right to claim or forcefully sell part of those pledged shares to get their money back. By doing this, David gets immediate access to the cash he needs, while technically still holding on to his ownership. The ultra-wealthy use company shares, real estate, or large investment portfolios all the time precisely for this purpose. Now, this naturally brings up two big questions. First, why would a bank actually go for this? Well, for the bank, it's a secured, relatively safe bet. I mean, they hold highly valuable assets as a guarantee, and they get to charge interest on the loan. But more importantly for us, why does David prefer paying interest on a loan over simply selling a tiny fraction of his billion-dollar company? What makes borrowing so much better?
Let's break that down in Section 3, Liquidity, Growth, and Taxes. This strategy essentially builds into a truly powerful financial advantage that comes down to three main pillars. Step 1, immediate liquidity. David gets the cash he needs for new investments or personal spending without disrupting his portfolio. Step 2, retaining asset growth. If David truly believes his tech company is going to keep skyrocketing in value, keeping his shares is vastly more beneficial than selling them today. If he sells, he completely misses out on all future growth of those sold shares. By borrowing, his entire billion-dollar portfolio keeps growing. And then there's step 3. This is probably the real kicker: deferring capital gains taxes. In many countries, selling an investment for a profit triggers a huge tax event. But a loan? A loan is generally not treated as taxable income because, by definition, it's money that eventually has to be repaid.
Now, as an impartial explainer here, it is absolutely crucial to note that tax codes vary wildly across the globe. What works perfectly in one jurisdiction might trigger massive, crippling penalties in another. This is exactly why individuals using this kind of asset-backed borrowing strategy never do it alone. They rely heavily on dedicated teams of professional financial advisors, tax attorneys, and wealth managers before making these high-stakes moves.
So, while getting cash, keeping your investments, and deferring taxes sounds incredible, like a financial cheat code, right? We need to objectively flip the coin here. We need to look at the hidden dangers of borrowing against your own wealth. Is it really a perfect, risk-free system?
Let's get into the downsides in Section 4, the risks of leverage. Borrowing against assets is fundamentally a form of leverage, which means you are basically walking a financial tightrope. Look at these risk factors. If things go sideways, say David's shares drop sharply in value, the bank suddenly holds weak collateral. They can issue what's called a margin call, demanding that David either provide more collateral immediately or make a partial repayment just to balance the scales. If David has an inability to provide that extra collateral, well, the bank isn't going to just wait around. The loan agreement gives them the right to forcefully sell those pledged assets to protect themselves, and that almost always happens at the absolute worst possible time, like right in the middle of a market crash. And even if the stock price remains perfectly stable, there's just the simple risk of accumulating time. Loans carry interest. Over a long enough timeline, compounding interest makes the cost of borrowing incredibly expensive.
Because of these strict obligations, it's important to understand this isn't just free money. It is a highly regulated tool, restricted mostly to people who already possess massive, high-value assets. It requires really robust, ongoing financial planning to ensure interest payments can be met. It involves super strict repayment obligations to the lending institution, and finally, it undeniably exposes core assets to market risks that they just wouldn't face if they were sitting unleveraged in a standard portfolio.
All right, let's wrap this all up in Section 5, the ultimate takeaway. So what is the fundamental truth driving all of these decisions? It really boils down to this one widely held mantra among the ultra-wealthy: never sell your assets if you don't have to. The primary lesson from our source material is that many billionaires deliberately choose to borrow against their assets to maintain their ownership and get the liquidity they need, rather than outright selling them and getting hit with taxes or losing out on future growth. They view their portfolios not just as a static store of value, but as a utility to be leveraged.
Look, the goal of this explainer isn't to tell you to go out and blindly copy billionaires. Most of us, myself included, don't have a billion-dollar tech company to pledge to a private bank. But understanding the precise mechanics behind these high-level financial tools completely demystifies how the wealthy think fundamentally differently about money, about debt, and about asset ownership.
So, I'm going to leave you with this thought to chew on. How do the rules of money shift in your mind when you realize that assets, rather than pure cash, are the true foundation of spending power? It really changes the whole definition of what it means to be rich, doesn't it? Thank you so much for joining me for this explainer. Keep analyzing, and I will see you next time as we decode another fascinating topic.